Hello, everyone, and welcome to the second policy panel of our conference, this time focused on the future agenda for financial stability. I'm pleased to say we have an absolutely superstar panel to discuss this question. Let me introduce the panelists briefly before I hand over to them. Firstly, I'd like to introduce Carolyn Rogers. Carolyn is the current Secretary General of the Basel Committee for Banking Supervision, a position she's held since March 2019. Carolyn also chairs the Basel Committee's Policy Developments Group. Prior to this, she was Assistant Superintendent of Regulation at the Office of the Superintendent of Financial Institutions, OSFI, in Canada. Next is Don Cohn. Don holds the Roberts v. Ruser Chair in International Economics and is a Senior Fellow in Economic Studies at the Brookings Institution. Until last month, I believe, Don served as an external member of the Bank of England's Financial Policy Committee. He was one of the founding members of that committee in 2011. And prior to that, Don was Vice Chair of the Board of Governors of the Federal Reserve System, a position he held between 2002 and 2010. Finally, Vitor Constancio. Vitor was Vice President of the European Central Bank from 2010 to 2018. Prior to that, he was Governor of the Central Bank of Portugal between 2000 and 2010, as well as then being Finance Minister in an earlier period in the Portuguese government. Vitor is now Professor at the University of Navarra, Madrid. And to chair our panel, I'm delighted to welcome Nicolas Veron. Nicolas is Senior Fellow at the Peterson Institute for International Economics, a role he's held since 2009. He's also Senior Fellow at the think tank Bruegel, which he helped found. Nicolas, let me hand the floor to you.
And I'll directly hand it over to Vitor.
Oh, Vitor, you need to unmute yourself.
No, I am unmuted.
We hear you, Vitor.
Yeah, okay. I thought so. Thank you very much for the invitation. And of all the possible subjects, I picked 2 points. One about non-bank and shadow banking, and another one about digitalization, and particularly the effect on banks. So starting with the first, the March 20 episode of market crisis and the need for central banks' big interventions revealed again problems with investment funds, money market funds, hedge funds, and also with the repo market. I will focus on that from that episode on the sell-off of treasuries in the US. It didn't happen the same way in Europe, but everywhere in both places, there were outflows from the funds I mentioned and problems of liquidity. In fact, the origin of the sell-off in the US was first the activity of hedge funds in doing the so-called basis trade, which is a sort of near arbitrage between the prices of treasuries in the spot market and in the futures market. And what happens is that when the repo rates, because repos are used in that basis trade, when repo rates go very high, and they had been spiking episodically even before, then the trade consists in selling spot treasuries, then do a repo lending, and then buying futures. Of course, if the future prices would go down too much as they started to go, then the hedge funds would incur in big losses. And they were saved, of course, by the intervention of the Fed in buying treasuries and also in injecting in March 1.5 trillion in the repo market to bring down repo rates. That's the first point. The second source was investment or mutual funds, as they are known in the US, that sold treasuries because of outflows. and they started to sell corporate bonds, but then they also started to sell treasuries. And then the Fed, and in Europe also the ECB, started QE, buying both sovereigns, but also corporate bonds, and even the ECB for the first time, commercial paper, which helped money market funds. The third component here is the repo borrowers and the repo market in general. Because repo, which has been at the core of the so-called shadow banking, this sort of new credit system outside banks, financing with very short-term liabilities, long maturities, repo is at the core. And there was the idea after 2008 that by moving repos to sovereign paper, the problem would be solved, and also some sort of central clearing, but it didn't. Because repo is a machine of transforming any drop in the prices of securities into a liquidity episode. Because there are initial haircuts, but then there are margin calls, and there is the big non-renewal risk, because most of repos are very short-term in the US, mostly overnight. And so it's a very precarious thing in terms of creating liquidity stress in the market. And so borrowers of repos with margin calls had to sell many things, including taking money out of MMFs and out of investment funds. And this means that this question of the repo market, to my surprise, has never been fully discussed by academics and others, because the problem is aggravated by the fact that there is a multiplier. Only last year, the American Economic Review published a paper showing that in the repo market of treasuries, there is a multiplier of 7. 7 times repos over the underlying paper. And so this is due to reuse and rehypothecation. So in my view, this needs some sort of regulation, both in terms of perhaps increasing maturities and limiting more the reuse and rehypothecation. A point about MMFs, which are in itself a different problem. As we all know, they were created because of regulation Q, and because in late 60s there was inflation and banks could not increase deposit rates. So here came MMFs offering short-term units, sort of deposits, because they were mostly created as constant NAV funds, meaning that they would keep units at par and there would be no problem, and they would remunerate somewhat more than the banks could. The banks could do everything that MMFs do, but because of regulation Q, they could not. And so they emerged. And of course, constant NAV MMFs are narrow banks without capital. That's what they are, their nature. And they cannot really resist an episode of big crisis and keep their promise, which is a misleading promise, by the way. So after 2008, the US transformed all MMFs into variable NAVs. And so the investors run the risk of the price decreases. But that does not solve the liquidity problem of the MMFs. And outflows will happen in a big scale, as they happened last year, and also in Europe, where particularly in France, there are variable NAVs, but there were also outflows. Because the funds have a problem because their asset side is made of commercial paper and things similar, issued by a few big firms, and collectively the funds own a lot of that paper. So there is not enough liquidity in a moment of stress, and that's why there is a liquidity problem, even with variable NAVs. So again, the intervention of central banks was crucial to address the problem, but is still remaining. The issue really of this type of institutions and their particular problems, because there would be only two possibilities in my view. Either the sponsors of MMFs, and normally it's banks that are sponsors of MMFs, either sponsors are mandatorily obliged to provide liquidity to these MMFs in moments of stress, or the central banks have to intervene whenever there is a crisis, creating more and more moral hazard. So there is a problem here of regulation. The deeper problem, of course, is the fact that the financial system has moved much more towards a market-based system where banks have shrunk. In the past, central banks could stabilize the system by stabilizing the banks, not anymore. And the deeper problem is, should banks enlarge their function, or which would imply stricter supervision, or should they only intervene in moments of crisis, ever increasing moral hazard? So that's the deeper question behind all this. So I hope I have time to just enumerate the problems.
Actually, if you can be very quick, because you already passed your time, Vitor.
Yeah, I feared that, but at least I sort of explained more or less what I wanted to say. So here I had, okay, it's not perhaps, it's very important, of course, all of the points, but to be very brief, banks have been, of course, eroded by the technological revolution because they were asleep about the payments systems, and then came huge platforms, took over the thing. But of course, they still have, the banks, a bit of the revenue, because ultimately deposits are moved to settle the accounts. And provided regulators don't change their basic views about if there are deposits, then it's a bank, then it's needed regulation as a bank, then big tech and big platforms will not embark in trying to have something like deposits. Then we have the threat of digital assets. Then we have the problems, huge ones, big risks around central bank digital currencies, which also may or not, but it's still not clear how it will be done, which also may erode the franchise of banks. And banks, okay, that's it. Thank you.
Thanks very much, Vitor. Dan, over to you.
Thank you, Nicola, and thank you, David, for inviting me to be part of this panel. This should be a very good discussion. And in fact, I'm going to develop some of the themes that Vitor put on the table. So I think what's next for financial stability policy, number one on the list, at least in the US, should be dealing with the issues that that overwhelmed the US Treasury market in March 2020, where the demand for funding liquidity overwhelmed the supply of market liquidity. This is a very serious thing. Prices of Treasury securities dropped during a flight to liquidity and quality. The safe haven asset price went down. The US Treasury market is a foundational market for the global financial system, repository of liquidity, risk management, pricing benchmark. And when it's broken, the system is broken. We've got to get this fixed. So Vitor gave a number of reasons about what happened here. Huge sales of Treasury securities and a dash for cash. The hedge funds he mentioned, the sales by open-ended funds, both money market funds and bond funds. I think another important seller, by the way, was foreign monetary authorities, and who were accumulating dollars because they wanted to help their banks and the people, the entities in their countries. The dealers did step up to make the market in treasuries, but not enough. The dealers were facing constraints from their own risk appetite, of course, but also from regulation, leverage ratio, perhaps liquidity requirements. So the Fed, as Vitor said, had to step in, and it actually purchased $1.5 trillion of Treasury securities in the last half of March and through April, over about a 6 or 7 week period, and a huge amount. So I don't, perhaps we can't expect the private sector to insure against a once a century pandemic, but I do think there were other episodes of Treasury market illiquidity, and I think this revealed some things that need to be fixed. So what do we need to do? We need to decrease the demand for cash under stress. And one of them, Vitor discussed, which was to work with the open-ended funds, both the money market funds and the bond funds, to eliminate first mover advantage for the holders of those funds. Those funds do a huge amount of liquidity transformation, unfortunate, and they promise overnight liquidity, and they're holding longer term and less liquid assets. And there is, the way they have worked, there is a incentive for people to get out fast when stress comes. So we need to deal with that. Rigorous swing pricing will help both on money market funds and bond funds. I think what really drove, Vitor, the money market fund run, at least in the US, was the threat of gates on the funds. So that has to be dealt with. And where it's not reasonable to even estimate swing prices for illiquid assets, I think authorities should look at creating new funds that don't promise daily liquidity. I think less pro-cyclical margining at central counterparties would be helpful. That would have helped the hedge funds. We need to look at other sources of non-bank leverage, securities lending, prime brokerage. We've seen some breakdowns in prime brokerage in the last evidence of those recently. And then we need to decrease the demand for cash, make it less pro-cyclical, increase the supply of market liquidity, increase dealer capacity, to see whether we can't make some changes in the post-global financial crisis reforms, which themselves have built a very resilient banking system, but maybe constraining some types of activities that we can relieve the constraints on without reducing resilience. The leverage ratio is one thing. The US authorities exempted reserves and Treasury securities from the leverage ratio in order to encourage market making and purchasing there. That exemption has lapsed. The Fed has promised some new proposals on leverage, but they haven't come out with them yet. So I think one thing would be to make that at least the reserves, the deposits at the central bank, permanently exempt from the leverage ratio. That's increasingly important as central banks do QE. So QE is forcing basically deposits and reserves on the banking system, and it's making that leverage ratio constraint loom ever larger. I think we ought to be looking at some of the liquidity requirements. There are a lot of different liquidity requirements for banks. They're overlapping. The banks themselves talk about the constraints. For example, in the US anyhow, the recovery and resolution plans impose constraints on liquidity, impinge on the substitutability of treasuries and reserves. So I think I don't know whether things need to be changed, but I think we need to take a hard look at all these things to see whether we can increase the capacity of the dealer banks to make markets in sovereigns and treasuries without impinging on resilience. And then the final thing I would mention would be a central bank standing facility for repo. So I think this ought to be given very serious consideration. The Fed formed a repo facility for foreign monetary authorities, and that was very helpful, taking pressure off the Treasury market, and perhaps that ought to be made permanent. But I also think they need to take a very close look at a repo facility for private parties. So I agree with Vitor. There's a moral hazard issue here, taking out the tail of one distribution on the repo market. But there's also a potential benefit to our economies and to our markets. So I think it should be at a backstop. It should be at a penalty to normal market functioning. It should be open and utilizable by enough counterparties that they can stabilize the market. And we do need to deal with those moral hazard issues either through regulation or through fees. So thank you, Nicholas. That concludes my remarks.
Thanks, Don. Caroline?
Thanks, Nicola. So I'll use my first few seconds just to say thanks to King's College, and it's a pleasure to be here with you and my esteemed panel members, Don and Vitor. Particularly pleased to see Vitor after a few years. Brings back good memories of sitting around the Basel committee table, hammering out the final bits of Basel III. So welcome back, Vitor. So I thought I'd begin with a sort of abbreviated version of the conventional narrative on the financial stability lessons so far that have emerged after a pretty extraordinary year. They go something like this. So banks have been so far part of the solution versus part of the problem. However, we may have some flaws in the regulatory framework in the form of buffer usability for one, perhaps procyclicality for another. The fault lines that have emerged were in the non-bank sector, NBFI in the regulatory parlance, and in market intermediation. And some of these warning signs look scary familiar. So this latest warning is a second chance to fix the things that we didn't fix last time. And surely we're not going to wait for a third warning. So my colleagues covered nicely the NBFI and market making part of this narrative. So of course, I'm going to focus a little bit more on banks. So first, it's undoubtedly true that banks entered the pandemic on a stronger footing than was the case during the global financial crisis. This really comes down to two main factors, the Basel III and post-GFC reforms, and the unprecedented range and degree of public support measures that have largely shielded banks. So we've been given another reminder, and this time a positive one, of the need and benefits for strong global prudential regulation. And we've been given another data point on the positive macroeconomic impact of capital and liquidity requirements for banks. We've also not seen a credit crunch that we saw in 08-09. And despite a lot of hand-wringing over buffer usability, when you look at the data, banks have so far continued to lend to the real economy. This was a key macro-pru objective of the Basel III framework, and so far it seems to have been achieved, albeit with a fair bit of outside help. But it's also much too early to declare a victory or a mission accomplished, and there's a few reasons for this that I'll outline. First, I'd say the real test to the banking sector may well be ahead of us and not behind us. Borrowers, and therefore banks, are still very reliant on public support and forbearance measures. Bank loans benefiting from government guarantees or moratoria still stand around 5% of total loans on average, and this number ticks up to well into the double digits in some jurisdictions. And market liquidity, as Don mentioned, continues to be supported by accommodative monetary policy and financial conditions. Second, even in a best case scenario where banks manage to navigate through this next phase of the crisis without incurring significant losses, and if the economy roars back, as many are predicting it will, the post-pandemic world will be one where the macro landscape is quite a bit more fragile than the pre-pandemic one. Government debt to GDP ratios are at levels not seen since after the Second World War. And global and household corporate debt now hovers about 170% of GDP globally. And the financial conditions in the last year have exacerbated what were already considered to be stretched asset valuations in some markets. So we know these are conditions from experience that often precede and definitely amplify shocks to the banking system. And third, recent events, Archegos, Greensill, Hurong, have all highlighted how stress and vulnerabilities in the NBFI sector somehow always find their way back to the banking system. So in short, there's reason to be optimistic, but there's also plenty of reason for banks and supervisors to maintain a pretty defensive posture in the near to medium term. There's still a compelling argument to curtail discretionary capital distributions and to err on the side of prudence in provisioning. There's little downside risk to either of these strategies. And there is both an opportunity and indeed a responsibility to look at the overall performance of the reforms, including whether or not buffers played their intended role. But I think we have another round to go before that test really yields any clear lesson. So where is the unfinished business then? Certainly in the non-bank financial sector, as both Vitor and Don set out. And here the argument is sometimes made, I might even have heard it briefly just now, that owing to bank regulation, risks have migrated from the non-bank sector, or from the bank sector into the non-bank and potentially the more lightly regulated non-bank sector. This is partially true, but banks remain connected directly and indirectly to the NBFI sector. So strengthening resilience in the NBFI is paramount to safeguarding the safety and soundness of the banking system and vice versa. Keeping this in mind is important as we search for solutions. Thinking of these as somehow separate arenas is not an ideal approach, and certainly diluting aspects of banking regulatory framework in support of secondary objectives like market liquidity can't be the answer. We shouldn't aim to move the risk around, we should aim to reduce it. So the international community certainly has its work cut out for it and has definitely mounted a full court press on these issues in recent months. I'm optimistic we'll make some progress this time. But there's also unfinished business in the banking sector in the form of the final set of Basel III standards, and we can't lose sight of this. The problems that these reforms were designed to solve haven't gone away, and they won't go away unless and until these reforms are implemented. And the problems in front of us, big problems like dealing with climate change, call for more global cooperation and not less. If we want to preserve the benefits and the credibility of global standards, we need to tackle unfinished business, yes, but we also need to implement the standards that we've already agreed to. Back to you, Nicola.
Thank you so much, and thanks to all of you for great points which leave us ample time for questions. I have questions maybe to start us up about the global framework. So we've alluded to the exemptions that the Federal Reserve granted from the leverage ratio provisions of Basel III, and these exemptions were on a temporary basis, but even taking that into account, my reading is that they were not in compliance with Basel III, especially the exemption of Treasuries holdings as opposed to central bank reserves. So I'd like to ask this question perhaps to Don and Vitor before maybe circling back to Caroline. Was this, what did you make of this violation of Basel III? Was it consequential? Did it have read across to other jurisdictions? And is there a legacy from that episode? Maybe Don.
So I think it was helpful in the moment for the Federal Reserve when it was purchasing these Treasury securities and when it was trying to encourage banks to step up to purchase Treasury securities to stabilize the market. I think it would be, I would not advocate for exempting Treasuries or sovereigns from the leverage ratio requirements on a permanent basis. The Fed has allowed both to lapse, but I think the reserves are a different issue, and that is consistent with Basel standards. I think it says, Caroline, temporary, but for the Bank of England, it's been 5 years. So I don't know what temporary means. So I think actually, and frankly, I think the leverage ratio is very important. In my early years on the Financial Policy Committee, I was trying to push the leverage ratio higher, not lower. But I do think that the risk, the Basel Committee has done quite a bit to strengthen the risk-weighted, the risk-based capital. So yes, the leverage backstop and the stress tests are a huge contributor to making sure that the risk-based capital is adequate and the floors put in Basel Committee. So I think the leverage ratio is still very important as a backstop, but I feel like it could be loosened a little for bank reserves or bank deposits without having an adverse effect on the overall resilience of the system, given the improvements we've made to the risk weighting process.
Vitor?
Yeah, very briefly. Yeah, the exemption of central bank reserves was not a breach of Basel III. There is an article there which foresees this possibility, although conditioned on increasing the requirements for other things in order to keep the same leverage ratio, something that I didn't agree. I really pushed very hard when I was at the FTSB during the discussions for the exemption of central bank reserves, which are totally safe, of course, almost by definition. And in times of QE, banks don't have really a choice there. It's totally different regarding the exemption of treasuries from the leverage ratio, and I'm totally against that. It was discussed during the discussions for the final agreement, and it was refused, and it should not really last longer because the leverage ratio is one of the more important measures that was taken with Basel III, particularly for European banks. The leverage ratio was already something existing in the US, but not in Europe. And that is a vital backstop to avoid the excesses and the gaming of the normal capital ratio that occurred prior to 2008.
So, Caroline, as Vitor just reminded us, the leverage ratio has been a big contribution of the Basel process to financial and banking regulation, particularly in Europe, also elsewhere in the world. What I take away from what Don and Vitor said is that there seems to be a consensus that the Basel standards should keep the prohibition of exempting sovereign exposures, even so that was temporarily violated by the Fed, but that the exemption of central bank reserves may be kind of made more permanent than it has been so far in the Basel framework, right? I mean, that's what I took away from Don. Are you considering that, basically removing the prohibition of permanent exemptions of central bank reserves, or is that a non-issue for the committee?
So the committee hasn't started debating any changes coming out of the lessons of the last year yet. We have initiated a review. We've got an evaluation underway. The results of that evaluation will feed the FSB report to G20. They'll very likely, at least in part, be published as well. So, I mean, what the Basel Committee is doing is what it's always done, which is we're going to be data-driven. We're going to try and take the evidence and draw the lessons. I mean, as Vitor said, the debate around central bank reserves on the leverage ratio was a long, painful debate. I don't think the argument is necessarily that there is risk in central bank reserves, but we had the leverage ratio appropriately calibrated all in. And I don't think anybody wanted to tackle a recalibration. So if we do revisit the issue, I think it follows logically that we would revisit the calibration too, which is I think what Vitor said as well. So,
Vitor, if I may continue on this, Caroline made, I think, a compelling case that the Basel III contributed to the fact that the banks met the initial shock of COVID-19 with high enough levels of capitals. And of course, as she mentioned, that was helped by also simultaneous public intervention to relieve them of some of the incoming risk. But the bottom line is, thanks God we had Basel III when the COVID-19 shock happened. Now, Basel III has a last bit, which has not yet been transposed into legislation, particularly by the European Union, and there is a lot of contention about it. I think we're expecting a proposal from the European Commission somewhere in the summer or after the summer, maybe, if the timetable slips a bit. And there will be active debate in the legislative process in Council and Parliament. What is your opinion of that? Should the EU adopt Basel III, the last bit of Basel III, in a compliant way, as Andrea Enria at the ECB has advocated, or should it water it down to take into account what the jargon calls the specificities of European banking business models?
Well, there was a long discussion that then reached the final agreement, and there was an agreement. So, these type of agreements should be respected. By the way, Europe already, regarding Basel II, didn't comply with some crucial points, like the limitation of the effects of on the capital ratio, because there was a sort of ceiling in relation to what would be the application of the standard method of calculating the ratio. Okay. And Europe did not comply with that, which was a big sticking issue during the final discussion on the final agreement, because it was a good argument for the US and others to insist on the final part of Basel III, which, as you know, is to be put into implementation gradually until 2027. Particularly the limits of the difference between what comes out of applying internal models and the standard method of calculating the capital ratio. Now, so Europe should comply. Nevertheless, there is perhaps a margin of international discussion, perhaps, in view of the pandemic. And the problem could be the following. Banks have indeed resisted very well, but particularly in Europe, they were supported by state guarantees and other things. So it is not yet totally clear that when those supports disappear, what will be the stress that the banks will put into. And if on top of that, there is further requirements coming out of that final agreement, that could or not be a problem, something to be seen and analyzed. But there is this possibility, so that could justify looking to the transitional period, but not changing the agreement at all, because it was a very important agreement. It was very costly to reach it, and it should be kept. The only thing that perhaps could be discussed, for the reasons I mentioned, would be the timing of the implementation of that agreement.
Don, what do you make of it? Should Europe, consider divergence from the last bit of Basel III, given the way its mortgage markets operate in some countries, et cetera, or should it be fully compliant? And what do you think about the transition?
So I don't have the kind of detailed knowledge of these issues that Vitor has. I think as a general principle, being compliant and being aligned with other countries and other jurisdictions is very desirable, because it creates a more level playing field in international competition. So I guess, Nicola, I don't have a view on the specific issues here, but I think we ought to try to find a common floor for these capital and liquidity requirements, because I think that will help the competitive environment.
It's also crucial for trust in multilateralism, which is
that's right.
That's consideration.
So the Commission has said it would be a guardian of multilateralism. But last time I checked, the Commission the European Union was the only jurisdiction in the world, or at least among Basel jurisdictions, that was materially non-compliant with Basel III. Caroline, is that still the case?
Yeah, I mean, in terms of jurisdictions who received a materially non-compliant rating on our regulatory consistency assessment program, the only jurisdiction that's received that rating is Europe, and that was on the first set of capital reforms. But I mean, I come back to Don's point. We need a floor, and we have a floor. We negotiated a floor. It's there. It needs to be implemented. There's a very long transition. We bumped it ahead a year again last year. if we now stick to our timeline, we're out 2028, we're 20 years after the global financial crisis. That surely has to be long enough to implement change. So, I mean, these are the, Nicola, these are the same banks making the same arguments. The pandemic has nothing to do with this here. This idea that you have to somehow choose between strong banks and a strong economy, that's just a false choice. Any bank that tells you that you can only have one or the other, you can't have both, that doesn't make any sense. And the idea that you either want a national or a global standard, or you want national specificities, but you don't spend years and painful hours and many consultations and many concessions and many compromises. Vitor was there to reach a global agreement and then have everybody go home and ask for national specificities. We could have all saved ourselves a lot of time and a lot of credibility.
Yeah, right.
But I think Carolyn's point about strong economies or strong banks being a false dichotomy is really important. And I think if you look at the recovery from the global financial crisis, jurisdictions like the US and the UK that forced their banks to raise capital and cope with their problems early ended up with a stronger banking system that was a more reliable transmitter of monetary policy. So got to get on with it. That's she was right on point there.
Yeah. Vitor, I cut you off when your body language was suggesting you had a reservation about the materially non-compliant label.
Yes, it was, in my view, controversial. The two of the points which I could not now describe to you or to the audience anymore, but two of the points, I think there was a certain exaggeration in the judgment of the committee on those two. But okay, it's water under the bridge.
So you questioned the conclusion of the Regulatory Consistency Assessment Program report of, I think, 2014.
Yeah, we criticized, not as much as the Commission did, but a little bit, yes. There were nevertheless one point that I think it was entirely justified. So, but let's not lose more time with that, and let's not create other sources of non-compliance in this field, which is of course very important.
So I'd like to come back to a point which Caroline mentioned about distribution policy of banks. So Caroline insisted that there's every reason for banks to maintain a defensive posture, but that's not exactly what we're seeing now. There is an eagerness to return to dividend distribution and even share buybacks, and a bit of a tug of war here. I'd like to have your views, both Don and Vitor, on where the right balance lies here in the US and in Europe on restrictions on dividends and buybacks. Maybe Don first.
So I think we have a system to evaluate banks' capital under stress and whether they can afford to distribute that capital, and it's associated with the stress tests. And I think as much as possible, we ought to stick with the established system. At the same time, I, as a member of the Financial Policy Committee, I was completely comfortable and backed the UK authorities' decision to urge the banks not to distribute capital in March, April of 2020, and I had advocated that the Fed take stronger action then. And the reason was because it was such an uncertain situation and things had changed so rapidly that the stress test from the previous year was no longer valid under those circumstances. So I think the best thing to do was to conserve that capital, rerun stress tests, or see how things evolved, and then, but as soon, I don't see any reason not to return to the standard determination of what capital adequacy is and how it can be distributed, just as soon as it's consistent with some removal of the uncertainty and confidence that's going to produce the right answer. So I would cutting it off, but then I would evolve back as quickly as possible.
So, but that's all principles. Concretely, do you think uncertainty has been reduced enough with vaccine and all that banks can return to normal now?
I think we can be moving in that direction. Yes. I mean, we're seeing very strong recoveries in economies, and maybe the US is leading, but other economies will be there soon as vaccines get put in people's arms. And I think some of the downside risk that people saw in 2020 is no longer there. Now, as Carolyn said, there are a lot of problems that are going to crop up as the economies reopen and businesses have to repay debts that have been guaranteed by the government, and what's going to happen there. So there's a band of uncertainty here, but I think we should be getting back as quickly as possible to business as usual.
Vitor?
Yeah, I agree in general with the question of the dividends at the beginning of the crisis. I think it was, for the reasons of uncertainty that Don mentioned, it was a good decision. Its prolongation, it's more doubtful to me, because indeed there are several problems there. One problem is that the distribution of dividends is very important for the share prices of banks, and banks suffered a lot. And if stock prices would be very down, meaning the cost of equity very high, if after the pandemic and after the end of the public support, banks would need indeed more capital to face to those consequences, then they would have more difficulty in raising it in the market.
If I had invested in bank stock 6 months ago, I would be very happy now.
Yeah, 6 months ago, but that's what I say, that initially it was justified, but say by the autumn, it could have been released, in my view.
Yeah, but I'm making kind of the opposite point, which is, the ECB has kept a relatively strict stance on dividends, certainly on buybacks, and that has not prevented a spectacular rebound in stock prices.
Yeah, that's true, because it was then related to the prospects of the recovery, of course, especially after the vaccines were announced and were there and started to be there. So you may be right on that, but that was my view at the time, that it could have been released, say in the autumn. And I think also that there was a sort of moral motivation behind the prohibition of distribution of dividends, which in itself, it's a question of political economy, if you wish, but it's not, say, a technical issue. But it was behind what happened at that moment. I have a different view regarding the stock buyback. I think that in the US there is too much of stock buyback activity. In some years, a big part of the demand for shares comes from share buybacks. And for firms to own, say, a big important chunk of their own capital, putting up the prices is somewhat arguable for me. In several European countries, there are limits to the amount of capital that the firms can own as a result of buybacks. So I am more on that camp of having some sort of limitation there, but not, of course, prohibition. That's not the issue.
Caroline, we heard both Don and Vitor, if I heard them correctly, saying, it's now time to go back to normal in terms of those distribution policies. You said maintain a defensive posture. To use Vitor's vocabulary, is that a moral or technical position?
It's both. It's both, and it's for the same reason. The motivation to restrict discretionary distributions was high levels of uncertainty and high levels of public support. And both of those things still exist, I think. Sure, there's an increase in optimism. I think there is more certainty in broadly speaking in the economy now than there was when these decisions were made. But I don't know that there's a lot more certainty about the impact on banks. As I said before, the impact on banks has so far been largely shielded. There's been all kinds of regulatory forbearance. There's been all kinds of monetary and fiscal support. We are talking a lot in the official sector right now about the delicate process of unwinding these supports and getting the timing right. If we move too fast, borrowers are going to be cash strapped. Banks are going to have to increase their provisions. Their profitability will go down. They'll constrain their lending. If we don't go fast enough, it's very likely that the effects on banks' balance sheets will increasingly become obscured. There's a chance that markets lose confidence in banks' reported capital ratios, and we could see a repeat of the stress that happens when that occurs. So there's a lot of delicate maneuvering that has to be done. And the way that I look at this is the capital doesn't go anywhere. So if a bank is very optimistic, and they think they've got it right, they think they've provisioned well, they think their risks are low, they can hold on to the capital and they can pay it out later. It doesn't disappear. As I said, there's very little downside risk to conserving capital right now, and a lot of risk to not doing it. So to me, a defensive posture makes sense, both from a regulator's perspective and from an investor's perspective. So
that was clear. We're getting closer, not yet very close, but closer to the end of this panel, unfortunately. And I have two questions from the audience. One, anonymous, is about LIBOR. And it's, oh, no, it's not anonymous. It's Keith Pilbeam asking, is the ending of LIBOR likely to create more risk to future financial stability than its benefits? And that's a very topical issue right now. The other question, which I will ask at the same time, is from Ines Ladasitz. CBDC is likely to pull more assets into central banks. Will this mean a greater role for central banks in credit allocation? So these are two of the biggest questions of the day, of course. LIBOR, CBDC, let's take them in maybe reverse order of initial speaking. So Caroline, then Don, then Vitor.
Well, banks have had, it's a bit like Basel III, banks have had ample time to prepare for LIBOR. Regulators have for years now been imploring banks to move on LIBOR. There's been a number of sort of accommodations. So I think there's been ample time. I think when push comes to shove, banks will be ready.
Don?
So I agree with what Caroline just said on LIBOR. Let's get on with it. There's a financial stability risk to sticking with LIBOR when banks don't want to report it. So a substitute needed to be found. Substitutes have been found. They're not perhaps perfect substitutes in the views of the banks in some respects, but I think enough time has passed. We've got to move on, and we can't keep forcing banks to report artificial prices as part of their LIBOR, as to establish LIBOR. On CBDC, I think it's a very good question how that, if there is CBDC, or if it's widespread, there already is CBDC, at least in China, there will be some, whether that will take deposits out of banks. And that's, I think, a downside risk to this thing. And I think the authorities need to think carefully about limits to deposits, how they can, and having the central bank then recycle that back into the banks would be a very difficult process. So I think it's a good issue, and one that the authorities need to think about and see if they can limit the disintermediation from the banking system, which will then, disintermediation from the banking system, of course, raises the cost of credit to private parties, assuming that the central banks end up recycling it back into treasuries, gilts, whatever standard central bank assets are.
Caroline, you didn't comment on CBDCs.
No.
Was that intentional?
No, sorry, I didn't know how you were going to do the rounds. I mean, I think CBDCs are still in the design phase, and it depends an awful lot on how they get designed, what the end risks are to banks, right? So you know, will they disintermediate deposits is one issue. A different issue is will they disintermediate lending. I think, you know, I think the central banks are alive to these issues. I think they appreciate the magnitude of them, and it's a big part of the thinking of design right now. So from a bank regulatory perspective, I'm trying not to get ahead of the central banks on this. They need to design them first, and then we can understand the risks and adjust the regulatory framework accordingly.
Vitor?
Yeah, let me start by pointing out that central banks have been sort of committing to introduce CBDCs, and now I hear and I read that the design is not yet concluded. The endeavor of CBDCs is a big one from you know, implementation point of view, but conceptually it should not be so complicated to really analyze the issues and then decide. But now it seems unavoidable. It's going to happen. Now, and central banks can do it only with deposits, not with tokens, would be anonymous and all that. Also, central banks will be very careful and will limit the amount of deposits that they will have themselves. Well, first, because to have all deposits potentially of all economic agents would be such a logistical, administrative endeavor and operational risk endeavor that they don't want to have that. Secondly, they would undermine banks in a big way if that would happen, and they don't want that too. So it will be limited, and it will be in cooperation with the banks, meaning that we can have a system where the citizens could ask for central bank digital currency at their banks, and the banks takes care of the transaction with the central bank. And then, of course, the central bank has to provide back the liquidity to the banks. Otherwise, the banks could not really operate.
So basically, you're with Don. You're suggesting a cautious, limited approach to CBDCs.
Absolutely. There is no other way. And by the way, China also has been careful so far with what they have done. So I think that's the way.
I would like to conclude this because we're getting, we need to finish on time. I'd like to conclude this with a very brief question. And sorry if this wasn't prepared.
No.
What keeps you awake at night? What's your number one risk? And what should we really care about? One single answer in just a couple of words for each. And I know it's always difficult to do it on the spot. Please don't elaborate. Just mention one single issue that you think should be the focus of attention, the risk you're most concerned about. Vitor, Don, Caroline.
Okay. From the perspective of urgency, of imminence of the potential risk, not in terms of the importance of the risk, which is a big distinction, because I would choose matters of digitalization and others like the ones we discussed. But in terms of urgency, I still fear problems with European banks after all public support goes away, and what will happen then. So I'm not sure. There won't be a general banking crisis. I don't think that, but problems.
All right, so second on my list after Treasury Market, which we already talked about, would be just, I think, asset values, and they seem to be stretched, as we say. And then what would happen if interest rates actually started to rise in a more persistent way? If, for example, inflation was higher than I think it will be.
So, but your number one remains treasuries.
I would like to fix that market. I think it's just foundational.
Yes.
And then number two is rising interest rates and the effects on asset prices.
Caroline?
Complacency. I'm a supervisor, so I'm worried about everybody getting overly optimistic and complacent. So
that's a very timely reminder for all of us. And we're not complacent about time. We finished on time, and over back to you, David. Thanks so much to all the panelists. I think this was a very rich discussion.
Let me really echo that. What a wonderful discussion. I'm so impressed. And Nicola, you did a wonderful job being the ringmaster, posing the difficult questions, but keeping us all on time. So a very big thanks to Caroline, Vitor, Don, and Nicola for a perfect end to our conference. Okay, we actually have one more item before we draw the conference to a close. So we've been running a Young Economist prize alongside the conference. And if you join us in, it's probably about 5 or 6 minutes, we will announce the winner of this prize, and we'll have the person here to kind of give his remarks. So see you in a few minutes. Hello and welcome back. So this is the conclusion of our annual conference. So a big thank you to everyone who's been with us for the past 2 days. I think it's been a really wonderful discussion, very wide-ranging and insightful. Now, as hopefully you'll have seen, we've been running a Young Economists prize alongside the conference, and we were really blown away with the quality of applicants we had or submissions we had for this prize. I'm delighted to say we managed to make a short list of the candidates that we thought were the best ones, and we now have a very short video showcasing some of their presentations that we'd like to play you.
Hi everyone, my name is Shohini Kundu.
My name is Alessandro.
Eski Kurt.
Diego Canci.
Jane Lee.
I am Christoph Lauper.
And I'm a third-year PhD student at the University of Mannheim.
My name is Rustam Jamilov. I'm a PhD candidate in economics at London Business School.
I'm currently a PhD in a joint program of financial economics at the University of Chicago.
I'm an economics PhD student at London Business School.
And I'm a fifth-year PhD candidate.
And my research interests are in monetary economics,
monetary and corporate tax policy,
macroeconomics, monetary policy,
with a particular focus on energy, climate change, and inequality.
I'm currently studying the macroeconomic effects of macroprudential policies in liquidity trade.
I'm an empiricist working on questions in the fields of financial intermediation, corporate finance, and macroeconomics.
I'm particularly interested in how different types of financial institutions contribute to financial instability and how they affect the real economy. Financial instability and how they affect the real economy.
So I'm Martin Wheel, and I was one of the people asked to judge the Young Economist. Okay, so my apologies for that shortcoming was the way I was handling the technology. I'm afraid that that's perhaps something that, a hazard that people who, have had as much time as anyone else to get used to this sort of technology, but haven't done it so successfully. It's just a hazard that we face. But I must say, seeing the entries submitted for the Young Economists competition made me really relieved not to be a young economist and competing in that sort of market. We had a short list of 8 entries to judge from, which were really high quality and covered a range of very important practical issues. When people used to look at theoretical aspects of economics, the practical application wasn't clear. In the work that we've seen today, or the work that we've seen in reviewing these scripts, there was a solid piece of theory and a solid application. All of the work was very relevant to the sorts of policy issues we've been hearing about during this conference. So now if I could pass over to Francesca and David to talk about the winners and runners up, please.
Yes, let me start, David. Thank you very much. I just wanted to echo that I was really impressed with all the submissions, and it was difficult for us to make a short list. I witnessed the difficulty of all the selection committee of you, Martin, and Dimitri Vayanos, and also Silvana Tenreiro in really making the choice and ultimately come up with runners up and winners. So let me announce the first runner up, which is Shohini Kundu, with her paper, The Externalities of Fire Sales, Evidence from Collateralized Loan Obligations. Shohini, congratulations. Your paper was really great. If you want to say something.
Sure. Thank you so much. I'd like to thank the organizers for giving me the opportunity to present my work. It's been wonderful seeing all of the presentations and posters over the last few days. And it's also a great honor to be recognized by the Qatar Center for Global Banking and Finance. And I'm looking forward to continuing the conversation offline. Thank you.
Thank you, Shahini. So I'll go next. So our second runner-up, and I really like this paper a lot, is Rustam Jamilov. Rustam, your paper is a macroeconomic model with heterogeneous banks, looking at trade-offs between stability and competition issues, which are kind of enduring questions that financial regulators look at. Rustam, as you can see from your background, is at London Business School. So many congratulations, Rustam. Would you like to say a couple of words?
Thank you very much, David, and to all of the organizers for this prestigious award. It means a lot to me. Thank you also for organizing a great conference. I've learned a lot, and I hope to continue speaking to you in the future.
Wonderful. And then Martin, would you like to announce the winner?
Yes, I'm very glad to announce that Alessandro Lin has won the prize for a paper, Monetary Policy and Payment to Income Limits in Liquidity Traps. And payment to income limits or debt service ratios, limits on debt service ratios, are something that have always been thought to be important, but this paper really shows their implications, and Alessandro suggests that perhaps we allow higher debt service ratios than would be optimal. At least that's if I understood the paper correctly. Alessandro, can I offer you my congratulations, please? And would you like to say something about the paper you submitted for this prize, the prize-winning paper?
Thanks so much, Martin. First, I'd like to thank the Qatar Center for Global Banking and Finance for the conference. And I also would like to thank you and Professor Aikman and Professor Monti for the organization and for the insightful presentations and panels of the last 2 days. I'd like to thank the organization also for considering my paper, and I want to say that I am honored to receive the award, especially given the great quality of the work of the other participants. Finally, if the audience have any comments on my work, I'm happy to discuss with you. Please feel free to reach out. And well, thank you again.
Well, please could I ask you to say what you think the most important findings of your work are?
Yes. So I think I'm currently still working on the effects of macroprudential policies in environments with low nominal interest rates. I think the main point of my paper is that tightening payment income limits while the economy is in a recession to begin with, that's very counterproductive, and that perhaps should not be a policy to be implemented while in a recession.
Okay, well, thank you very much indeed. That, I'm sure, is something that financial regulators will want to pay attention to, because, of course, as we've learnt, learnt at this conference, there's a strong relationship between financial regulation and the policies that are needed to address recessions. So could I offer my congratulations once again to you as the winner of this prize, and pass us back to David and Francesca.
Martin, Alessandro, thank you very much indeed. Rustam and Shahini as well for participating in this. So that draws our conference to a conclusion. Francesca, do you want to maybe just as some closing remarks, what's kind of pick out a couple of things that have struck you from the discussions we've heard over the last 2 days?
Certainly, thank you, David. So, I think the conference touched on many important questions that are facing central banks in the years to come, both concerning policy frameworks and the effectiveness of their tools in this kind of challenging economic environment. I'm going to focus on 2 key points that I think are important avenues for research, but also relevant for policy, some of which have been explored in the papers presented at the conference. So first, from a more policy perspective, I would like to emphasize the attention given during the conference to institutional design and to making sure that it responds to the challenges posed by the increased monetary and fiscal policy coordination, and by the push to expand remits to areas such as climate change that are not traditional turfs for central banks. This is important for the credibility of central bank policies and thus for their effectiveness. The other issue I want to point to, and which in some sense is related to credibility and to the way that policy is transmitted, is how economic actors understand policy actions. That is, the role of beliefs and the way we model them. So very nice papers in the program and among the posters have looked at the implications of modeling beliefs and attention in more realistic ways. For example, when looking at monetary policy or when thinking about house prices, and for the perception of climate risks. I would also like to talk about the importance of heterogeneity and thinking about distributional aspects, but since you said 2, let me leave it there for the sake of time, and let me hand over to you for your really concluding remarks. Thank you, David.
Thank you, Francesca. And I think if I was going to pick out 2 things, I was really struck this morning by what Nick McPherson told us about the asymmetry in the coordination problem between monetary policy and fiscal policy, and how those risks intensify in an environment of rising interest rates. And I think that could be a big issue on the horizon, I think. And the second thing is something that really came out in one of the paper sessions this afternoon and the policy panel, the emphasis on the kind of gaps that have emerged in central banks' liquidity frameworks, driven by the growth of the non-bank sector. So, we now have frameworks for providing liquidity in stress situations to the banking system, but much less so to markets. And that feels like an issue that kind of erupted about a year ago in March 2020, but it's something that we really need to fix urgently, I think. Okay, with that, I think we can draw the conference to a close. So a very big thank you to all of our speakers, all of our discussants, everyone in the audience for participating so fully in the discussions over the last 2 days. And let me just say, hope to keep in contact with you all and to be able to welcome you to London and to King's College before too long. Take care, everyone. Bye-bye.